The global consumer lending industry sits at the center of modern economic activity. It transforms a household's expectations of future income into present-day spending power. This mechanism supports the economy's physical footprint. Mortgages, auto loans, personal credit, and student financing dictate the pace of housing, business formation, and retail consumption. This diagram shows the financial engine behind that consumption, the spread. Lenders build a profit channel by capturing the gap between their own baseline borrowing costs, the blue line, and the yields they charge consumers on loans, shown in gold. During periods of stable economic growth, lenders manage default risk through strict underwriting and liquidity models. As long as interest rates remain low and predictable, this spread produces highly scalable, reliable earnings. Because this scalable structure is so deeply embedded in household finances, it is the bedrock of economic expansion. But that exact same structure leaves the industry highly exposed the moment liquidity conditions tighten. When inflation rises, central banks intervene. They raise interest rates rapidly, intentionally increasing the cost of capital to cool economic demand. This introduces an immediate contradiction for the lending sector. On paper, institutions can now charge materially higher yields on newly issued loans, but simultaneously, their existing borrowers face rising repayment burdens, making new credit less affordable. A lender starts with a 6% spread, borrowing at 4%, lending at 10%. When rates shock, yields jump to 13%, but funding lags at 6%. This artificially inflates margins, masking the reality that borrower solvency is cracking. If observers focus solely on these short-term accounting metrics, they get a misleading signal. Expanding margins early in a tightening cycle usually mask the early stages of severe credit deterioration. The reality of the rate hike eventually hits the household level. For consumers carrying floating-rate mortgages or those forced to refinance fixed-rate debt originated years earlier, monthly obligations spike rapidly, regardless of whether their wages have grown. Early stress typically appears first in lower-income borrower cohorts. Because these households maintain smaller cash buffers, their budgets are highly sensitive to even minor increases in debt service costs. As household cash flows break, the financial fallout travels back to the institutions. Lenders begin recording rising delinquency ratios and increasing charge-off rates, forcing them to lock away capital to cover the damage. This animation illustrates loan loss provisioning. Any lender expecting future defaults must reserve a portion of today's earnings to absorb the losses anticipated tomorrow. The moment management decides to increase expected credit losses, earnings quality changes completely. If a company reports stable top-line revenue, but simultaneously mandates sharply rising provisions, the accounting illusion is over. They are signaling that the underlying loan book is deteriorating. Inside the institution, survivability depends on how the balance sheet is constructed. Firms heavily reliant on short-term wholesale funding are highly vulnerable to sudden liquidity shocks, while lenders funded primarily by stable customer deposits have a much stronger defensive posture. This clock visualization demonstrates a lethal structural threat, duration mismatch. If an institution holds long-duration fixed-rate loans, but funds them with short-duration liabilities, rising interest rates compress their economic value and create immediate refinancing pressure. Zooming out to the broader macro environment, inflation has systematically reduced real disposable income for many households, while the savings accumulated during pandemic stimulus periods have largely normalized or vanished. To bridge the gap, households increasingly rely on unsecured credit card balances to sustain their consumption. They are substituting stable income with dangerous leverage. The true damage in consumer lending is almost always delayed. Aggressive credit expansion during low-rate environments allows weaker borrowers to accumulate leverage. Those loans only become toxic time bombs years later when refinancing costs surge. Now introduce a systemic liquidity freeze. A sudden macro event makes financial markets highly risk-averse. Wholesale funding tightens overnight, securitization demand evaporates, and institutional refinancing access deteriorates. The immediate survival reflex for lenders is severe contraction. They tighten credit standards, halt new loan issuance, and cut off consumer access to easy refinancing. The blowback hits the real economy instantly. Facing elevated interest burdens and a sudden lack of credit, households are forced to hoard cash. Discretionary spending plummets. This structural diagram illustrates the brutal reversal of operating leverage. Compliance, servicing, and branch costs are entirely fixed blocks. When new loan growth decelerates and revenue shrinks, those rigid costs press down on the institution, crushing profitability. During a liquidity freeze, the exact financial mechanics that compounded earnings on the way up act in reverse, accelerating the speed of institutional failure. When the cycle turns, the market aggressively separates the resilient from the fragile. Institutions with strong Tier 1 capital ratios and low-cost deposits continue lending selectively. Firms overly concentrated in subprime or unsecured debt face credit downgrades and forced balance sheet contraction. The optimistic scenario for the sector relies entirely on employment. If labor markets remain sufficiently resilient, mass defaults are prevented. Lenders can maintain profitability through higher loan yields, absorbing manageable increases in delinquency. The downside scenario is less forgiving. Persistent high interest rates eventually overwhelm household cash flows. That triggers a vicious cycle. Broader credit deterioration leads to rising unemployment, which tightens financial conditions and reinforces further defaults. Observers navigating this environment must monitor specific warning signals: accelerating net charge-offs, sudden shifts in deposit stability, declining capital adequacy ratios, and the expanding gap between wage growth and debt service growth. Near-term accounting profits on an income statement offer little protection. A lender's long-term survivability relies entirely on strict institutional liquidity discipline and the underlying consumer's ability to withstand structurally higher borrowing costs.